Welcome back, everyone. I hope you're having a great day. And in this episode, we're going to take a look at 5 growth companies worth keeping your eye on for the upcoming trading week. If you're new to the channel, this is a recurring series where every single Sunday we discuss the upcoming major events for the next trading week and all of the companies who may be impacted. These are either earnings reports, new product launches, investor presentations, or any major event that could impact a company's share price over the shorter term. And in this week's episode, we have a nice diversified list of companies, primarily growth names, who operate in very different industries. We have some beaten down tech companies, some fast growing consumer names, and also some of the leaders in the advertising and mobile content space. So a nicely diversified list of growth stocks worth keeping your eye on for this upcoming trading week. And before we jump into stock number 1, I'm going to ask you to please hit that like button and subscribe. I am the Gen Z investor, and every single day we talk about the stock market, going over different stocks you can buy and any major market news. So please hit that like button, subscribe for the daily videos. And the first company that we're going to go over in this episode is ticker LULU, which is Lululemon. They currently trade for $323 per share and are up by 13% during the past year. The company now has a market cap above $42 billion, and this is one of the fastest growing consumer fashion and apparel companies on the public market. And we can see that over the past 5 years, the share price has climbed up just under 400%. They've built up a fan base of extremely loyal customers, and Lululemon sells a premium product. Their products are very expensive, but they come with extremely high quality, and they build up a very loyal fan base. And over the past year, even though the company's revenue continues to climb to record highs, the share price still sits down 19% from the high point back in late 2020. So now may be an excellent opportunity to pick up some shares of Lululemon below the 52-week high. And they're included in this week's episode because the company's sharing their latest earnings later on this week on June 3rd. And we have a revenue estimate of $1.12 billion with EPS to come in right around 90 cents. And we can see that over the previous 4 quarters, they've missed expectations once, but have followed up with 3 consecutive major beats over the guidance numbers. And for this next quarter, they're forecasting 310% year-over-year expansion in the company's total earnings, which would be absolutely phenomenal. And we can see that throughout the pandemic, when consumers were forced to go shopping online, that posted a huge benefit to Lululemon. Their digital growth exploded over the past year, and the company's CEO believes that growth will continue even after the pandemic comes to an end. He sees the trend of online shopping only continuing to grow, and his brand Lululemon dominating in that industry as well. And for a company like this fashion and apparel name, they have extremely strong brand loyalty. People who buy Lululemon products love the company and continue to buy more. And in 2020, their brand value grew by 40%, which is absolutely phenomenal. And if we take a look at the financial numbers, they have no signs of slowing down. Their total revenue over the past 5 years continues to expand every single year, reaching record highs of over $4.4 billion in the trailing 12 months. So a continuous upward momentum, which is phenomenal to see. And if we take a look at the bottom line, this company, because they sell a premium product, they have some nice margins, and they've been profitable over the past 5 years as well, with just under $600 million of net income coming in over the past year. And going forward, analysts on Wall Street have set very high expectations for the company's future growth. And throughout this full fiscal year, they're expecting total revenue to climb to $5.6 billion, representing growth of over 28%. And then next year, they're forecasting total sales of over $6.6 billion, representing another 17% growth in the total top line. And overall, the company's total expected growth rate sits around 23% per year for the next 5 years going forward, and the stock is considered a buy, coming in at a 2.1, and the current share price of $323 sits nicely below the 12-month expectation of $385 per share, so some implied upside over the shorter term as well. So Lululemon, a very strong company in the consumer/fashion and apparel industry, they've grown very well over the past few years, and analysts are expecting that the strong brand loyalty, the transition into e-commerce, will allow this company to see continued growth for many years to come. And now as we transition into the second stock in this episode, we're going to go over ticker FB, which is Facebook. So now we have a big tech leader that currently trades for $328 per share, and they're up by 45% over the trailing 12 months. The company is now valued with a market cap at $932 billion and trades with what I believe to be a very attractive forward PE ratio of only 25.2. And I included Facebook in this week's episode because the company is hosting their annual developer conference on June 2nd. Of course, it will be virtual this year and live streamed all across the world. They're going to give updates on the Facebook ecosystem, new products, new developments, and share their plans for future expansion of the overall Facebook brand. So I'm really looking forward to this event, tuning in, watching what happens and all the major updates, and I think it will be really positive for Facebook because they had to cancel the event last year due to the pandemic. This has become highly anticipated, and we're really looking forward to hearing what Facebook has to say. And the event takes place on June 2nd, later on this week. And although Facebook is already a leader in the tech sector, they have incredible revenue and earnings growth, amazing balance sheet, and strong free cash flow. The company is not slowing down whatsoever. And over the past quarter, their total revenue grew 48% year over year, which is absolutely phenomenal. And the company continues to impress. Taking a look at the numbers, over the past 5 years, their total revenue has gone from $27 billion all the way up to over $94 billion in the past 12 months, more than 3xing in a matter of 5 years. And going forward, the growth is not projected to slow down whatsoever. And according to analysts, they're expecting another 34% expansion in Facebook's total top line this year, bringing up the total revenue to around $115 billion, and next year growth to $137 billion, bringing up another growth rate of around 19%. So overall, this big tech giant, who still provides great numbers, growing revenue, expanding business model, is hosting a very highly anticipated event this week. Their numbers have been phenomenal, and going forward over the longer term as well, analysts are forecasting 23% expansion every single year for the next 5 years going forward. And at this current point in time, the stock is considered a strong buy, coming in at a 1.8, and the share price of $328 is below the 12-month expectation of $386, so similar to Lululemon, some implied upside from this big tech giant. So they're the second company I believe are worth taking a look at later on this week. I think this event will be really beneficial for Facebook. They did not host it last year, and I think every investor who follows along with this company and likes their innovation is going to be highly anticipated, will tune into this event, and if they share some great updates, the share price may see some continuous momentum and bring the company to new all-time highs. So that was the second name to take a look at for this episode. And now if we transition into stock number 3, it's going to be ticker AVGO, which is Broadcom, a big semiconductor player that trades for $472 per share and has grown by 66% during the past year. They have a market cap at $192 billion and trade with a forward PE of only 17.5 with a nice dividend right around 3%. So this is a company that offers a lot of share price appreciation plus a fast growing dividend with a very attractive valuation and a low forward PE. So a lot of good things coming from Broadcom at this current point in time. And we can see that over the past 5 years, they've grown by over 200%, and I've included them in this Sunday's episode because the company reports their latest earnings on June 3rd after market close. We have a revenue estimate of $6.5 billion with EPS of $6.46 for the quarter. And we can see that over the past 90 days, analysts are getting more and more bullish on this report and have upped their guidance numbers by 24 times, while we've seen only one single downgrade. And over the past 4 quarters, They were in line once and then have seen 3 consecutive beats on EPS expectations, and we're forecasting another 25% expansion over this past quarter. And going forward into the future, we're expecting some nice double-digit growth to close out fiscal 2021. And if we take a look at Broadcom's investor presentation, they've been performing extremely well over the past 5 years, leading to the 200% appreciation in the company's share price. Taking a look at the financials, net revenue continues to grow every single year to over $23.8 billion in fiscal 2020. Their gross margin is extremely high and still continues to grow as the company achieves greater scale to over 73%. They have massive adjusted EBITDA of $13.6 billion. And then finally, probably my favorite financial metric to take a look at when evaluating a dividend company is their total free cash flow. And Broadcom has seen some tremendous growth from around $2.68 billion of total free cash flow back in fiscal 2016, all the way up to around $11.6 billion in fiscal 20. So they've more than 4x their total free cash flow in only 5 years, which I believe to be extremely strong. And right now, the company has also seen some incredible dividend growth. So if you were to buy into Broadcom, your starting yield currently sits at 3%. And their annual dividend payment has seen a ridiculous CAGR of 49% since 2016. Back in 2016, their total annual dividend was $1.94. And over the past 5 years, that has now grown to over $14.40 per share per year, growing at a CAGR of just under 50%, which is absolutely ridiculous. So this company not only has provided their shareholders with a lot of share price appreciation, up over 200% in the past 5 years, their annual cash flow paid out to their investors continues to grow at a massive rate as well. And going forward, and also projecting around 8 to 9% per year share price appreciation, tie in that 3% growing dividend, you're looking at a nice double-digit return expected from Broadcom for the next 5 years. And currently, the stock is considered a buy, coming in at a 2, and the share price of $472 sits just below the 12-month expectation of $512 per share. So overall, Broadcom is definitely a company worth keeping your eye on for this upcoming trading week. I own this stock in my personal portfolio. It gives me exposure to the semiconductor industry, and I think going forward, that entire market will continue to grow, and Broadcom will see some long-term share price appreciation, plus continuing to grow that annual dividend in a high double-digit manner for many years to come. So Broadcom, they shared their latest earnings on June 3rd, definitely worth taking a look at for this next short trading week. And now we're going to continue on and jump into stock number 4, which is ticker ZM, and that is Zoom Video. They trade for $331 per share, and over the past year, they're up by 102%. They have a market cap just around $97 billion, and I'm sure we all know this company. The video communication platform that exploded in demand due to the 2020 pandemic, and we can see from their IPO back in 2019 to the height of the pandemic, they went from around $65 per share to all the way up to $588 for their 52-week high, which is absolutely phenomenal. But from that record high point, this company has seen a major downturn. From October 2020, they have now fallen by over 41% back down to their current level. So many investors have locked in profits from the pandemic highs and are now shifting that capital into more stable blue chip companies. But some investors are now counting out Zoom as if the company is done. Just because the pandemic is coming to an end does not mean that this company is over. I think video communication is here to stay. Regardless if it's safe to be in a room with other individuals, the ease of use, the productivity, the saving of time that these communications platforms provide, I think will allow them to be a part of our business lives for long into the future. And now, getting the same meeting done can allow any individual to be part of it all around the world, and there's no need for travel, wasted time, transportation, and it saves a bunch of money, and everything can still get done through these platforms. and the company's coming out with new products to expand their base, and the company's included in this week's episode because they are sharing their latest quarterly earnings on June 1st after market close. We have a revenue estimate of around $907 million with EPS of 98 cents. And for the quarter, we're getting some nice high expectations, 16 upward revisions for the EPS number, and no downgrades. So analysts overall are liking this report more and more and are setting some nice expectations. And we can see they've beaten the results over the past 4 quarters, and they're forecasting 390% expansion for this latest report as well. And I think Zoom Video will still post strong revenue growth over the next few years because of their long-term contracts with their clients. And we can see growing future revenue under contract from the previous quarter came in at $1.75 billion. $1.7 billion of revenue in future contracts is sitting on the company right now. So for all those investors who believe the company is going to go dramatically downhill, it was a 1-year spike in sales, and those are all going to drastically be sent off, I think you're unaware of how the company actually operates. A lot of major organizations still have long-term deals with Zoom that are in place over the next few years. And like I mentioned earlier, I believe Zoom will still be part of business over the long term, and this company will still have continuous generating revenue for many years to come. And if we do take a look at their income statement, although they have seen a major expansion from only $600 million of revenue back in 2020 to over $2.6 billion in the trailing 12 months, I don't think we'll see Zoom go to zero anytime soon. And going forward, Wall Street still has some pretty decent expectations for the company for the next 5 years, forecasting 17% annual expansion for this tech company. And currently, the stock sits between a buy and a hold, coming in at a 2.3, and the share price of $331 is actually below the 12-month expectation of $429 per share. So a lot of implied upside over the shorter term as well, coming from Wall Street. So the fact that Zoom has fallen 40% from their highs now may make this company a more attractive buy, especially after taking a look of their earnings that come out on June 1st. So Zoom Video was the 4th company included in this week's episode, and now if we transition into the 5th and final name we're going to discuss today, it is ticker TTWO, which is TakeTwo. They currently trade for $185 per share. They've grown by 38% over the past year, and the company has a market cap of over $20 billion. And this is a leading video game company that has a strong suite of products and brands diversified across many different types of the video game industry. And going forward, that entire sector is only expected to grow over the long term, and the total addressable market is projected to expand on a global scale. And Take-Two, they have a nice diversified suite of products in the video game sector, has fallen by over 13% from a high of $213 back down to this current level. And they're included in this week's episode because the stock was just updated by BMO Capital. They upgraded Take-Two to an outperform or buy rating, and they believe the stock, because of the overall transition in the video game sector and the strong brands and different series that is owned by this company, they will continue to outperform the overall market over the next few years. And taking a look, Take-Two owns the brands such as Grand Theft Auto, NBA 2K, Red Dead Redemption, Borderlands, and many more, as well as some top mobile games including Dragon City, Monster Legends, and WWE Supercard. So overall, a nice diversified suite of products. They have some shooter games, some overall consumer brands, some sports games, and some nice mobile apps targeted toward the younger generation as well. So Take-Two, a big player in the video game sector, they've seen their net bookings grow by a 17% CAGR over the past few years, and they have some subscription-based revenue as well, and recurrent consumer spending grows every single year as well, which is absolutely phenomenal at a CAGR of 38%. And taking a look at the income statement, total sales continue to grow like we've seen for all the stocks in this video to over $3.3 billion in the trailing 12 months. And currently, the company is expected to grow by over 13 to 14% per year for the next 5 years going forward, and the stock trades for $185, below the $220 price expectation over the next year, and is considered a slight buy, coming in at a 2.1. So this video game company was the fifth and final stock we're going to go over in this episode. And as we wrap up the video, I want to thank you for watching to the end. We went over 5 different growth companies we're taking a look at for this upcoming week. We saw a couple earnings reports from Lululemon, Zoom, and Broadcom. We saw Facebook's new developer conference, and of course TakeTwo, the video game company, just received an upgrade from BMO Capital and may be worth looking at for your own portfolios. So I want to thank you for watching this video to the end. Please hit that like button and subscribe. I'm the Gen Z Investor, and I will see you in tomorrow's video.